Traditional IRA, Roth IRA. Have you ever wondered what these things are? Keep watching for a beginner-friendly explanation of these, where we will look at the similarities, differences, and pros and cons of both. By the end of this video, you will have an understanding of what these accounts are, how they can help you, and which will be a better fit for you and your goals. And if you want more videos related to business, investing, or tax, just hit the subscribe button for weekly video updates. Let's get started. To start, what are these? Both the traditional and Roth IRAs are accounts that are meant to help you save and invest for retirement. IRA just means individual retirement account. These aren't the only IRAs you can choose from. In fact, there are 7 in total. But they are definitely the most common. Here's a full list. Sometimes you'll hear these called IRAs, but personally, I like IRA. So that's what you'll hear me call it. These are types of accounts, which means the IRA is not the investment. These accounts allow you to hold investments within them. These include stocks, bonds, ETFs, and mutual funds. Like other investment accounts, you'll need to go through a brokerage, such as Fidelity, to set one up. So to recap, the actual IRA is not an investment. It's simply an account type that will hold your investments. Now that we understand what an IRA is, let's explore how the traditional IRA and Roth IRA are similar. Both have a contribution deadline of April 15th of the following year. So, for example, for tax year 2019, your contribution deadline was April 15th, 2020, not December 31st, 2019. Contribution limits are the same for both. In tax years 2019 through 2021, the contribution limit was $6,000. $7,000 if you're 50 or older, as long as you meet the income guidelines. You can contribute to a traditional or Roth IRA even if you have an employee-sponsored retirement plan, like a 401k. Anyone can contribute to either, including minors and non-working spouses, as long as they meet certain income rules. In tax years 2020 and forward, there is no age limitation to either IRA, but in the past you could not contribute to a traditional IRA past 70 and a half. So these two accounts are very similar, but what makes them different? The main difference between these two is the tax treatment. In a traditional IRA, you will have an above-the-line deduction for your contributions. If you aren't sure what this means, go back and watch my Tax 101 video. These deductions can be subject to some limitations, which we will get into more in a future video. For now, just know that you may be able to deduct the amount you contribute to a traditional IRA from your income, which lowers the amount of money you get taxed on. With a Roth IRA, you do not get any tax deduction on your contributions. So, knowing this, why would anyone choose a Roth over a traditional IRA? One gives you a tax deduction while the other does not. With a traditional IRA, you get a current year tax deduction. Your money grows over time, and when you retire, you are taxed. You get taxed on the contributions you put in, because since you got a tax deduction, that money was never taxed. You also pay tax on any capital gains, so any amount over your contribution. Tax deduction now, get taxed at retirement. With a Roth, you miss out on the current year tax deduction. Your money grows over time, and when you retire, no tax. You do not get taxed on your contributions because you already pay tax on this money, nor do you get taxed on any gains. It's all tax-free. The next difference relates to penalties. With a traditional IRA, you pay a 10% penalty on early withdrawals. This includes contributions and earnings. There are certain conditions in which your penalty can be waived. I'll post a link to the IRS chart showing a list of the exceptions in the video description. With a Roth, there are no such penalties as long as your withdrawals do not exceed the total amount of contributions. proven it's been 5 years or more since you first contributed. You will get a 10% penalty if you withdraw any earnings, though. Another difference is required minimum distributions. With traditional IRAs, you are required to take a certain amount of money out by April 1st of the following year you reach 70 and a half, and every year after by December 31st. This requirement does not exist with Roths. So which will be a better fit for you? Let's look at the pros and cons of each. Traditional IRAs help you save money on tax today. Getting a current tax deduction means you don't pay tax on that money, which means you get to keep more of your money today. Your money gets to grow tax-free, but the downside is you will pay tax later when you retire. You will also be hit with a 10% penalty for early withdrawals. And the last con is that you will be hit with required minimum distributions, which you have to pay tax on. What about the Roth? The first con is that you miss out on a current year tax deduction, so you will pay more in taxes today. But your money grows tax-free, and you do not pay tax when you withdraw the money at retirement, which includes gains. So you'll have more money later. You are not subject to RMDs, and you can avoid early withdrawal penalty as long as it's equal to or less your total contributions, subject to certain conditions. Ultimately, the best choice for you is going to depend on what you expect your rate to look like in the future. If your tax rate is lower today than it will be in the future, it's possible that paying tax today will be in your benefit. If you expect your tax rate to be lower in the future than it is today, then you might be better off taking a tax deduction today. You don't have to choose one or the other if you can't make up your mind. They each have their benefits. You can contribute to both as long as you fall within the contribution limit. So just to be clear, you can contribute $3,000 to each for a total of $6,000, not $6,000 to each account type. These are the main similarities and differences for you to consider. The next video in this series will explore the income limitations, so keep an eye out for that one. If you found this video helpful, consider sharing it with a friend and hitting the like button. Drop any questions or ideas for future videos in the comments below. Until next time, guys.